Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at DDS, or Dillard's Inc. DDS ranks among the nation's largest fashion retailers. Here's the barchart.com technical opinion for DDS. The bar chart technical opinion rating is a 100% buy, with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bull trend on a monthly basis. If the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that DDS is well above the moving average line, so the monthly trend in DDS is up. Now we're going to look at the daily chart. Stock is in a bull trend on a daily basis. If the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since late last year, so the daily trend is up. Since the monthly and daily trends are both up, DDS is on our buy list. Next, we're going to look at our daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. The DDS stock price is below the upper Keltner channel line, so DDS is inside the buy zone. Since the trend is up, we want to buy a call. DDS has 6 option chains to choose from. We're going to use the September 17 option chain. Right now, the September 17 options have 32 days to expiration. Here's most of the DDS option chain for September 17. DDS closed at 196.21 on Friday. That means any calls on the list from 195 to 100 are in the money. Let's take a look at the profit potential for purchasing the DDS 195 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 195 call is 13.90 to 17. We try to enter at the midpoint, so we'll use 15.45 as our buy price. Our call option calculator shows the profit potential for this call based on DDS price changes at option expiration from flat to a 12.5% increase in price. We can see that if the DDS stock price is flat at 196.21 at option expiration, the 195 call will lose 92.2% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 170 strike call to see if it qualifies for the 1% rule. Here is the call option calculator picture for the 170 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the DDS stock price is up 1%, the 170 call will lose 7.9% of its value. We want that to be break even or better, so the 170 call does not meet our requirements. Let's see if the 150 call will work. The bid-ask spread for the 150 call is 45 to 49.50. We try to enter at the midpoint, so we'll use 47.25 as the buy price. The 150 call works. If the DDS stock price is up 1%, the 150 call will make a 2% or $92 profit. That's better than break even, so the 150 call is the one we'll buy. The call option purchase calculator also shows that if the DDS stock price increases by 2.5%, the 150 call will make an 8.2% or $387 profit. If the DDS stock price increases by 5%, the 150 call will make an 18.6% or $877 profit. If the DDS stock price increases by 7.5%, the 150 call will make a 28.9% or $1,368 profit. 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the DDS stock price does not make the expected move up and remains flat at expiration, the 150 call would only lose minus 2.2% or minus $104 compared to the 92.2% or $1,424 loss for the 195 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the DDS September 17 expiration 175 strike call and sell to open the DDS September 17 expiration 185 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 175 call for $26.55 and sell the 185 call for 20 even. 26.55 minus 20 equals 6.55. So the entry price or debit cost for the spread is $655. The call option spread analysis calculator picture shows that the spread will make a 52.7% or $345 profit if the DDS stock price declines by 5%, remains flat, or increases in price when the options expire. If DDS is down 7.5% at expiration, the spread will lose minus 0.9% or minus $6. Creating the debit spread will allow us to collect a $2,000 cash credit to our brokerage account for the sale of the 185 call. As we said on the previous slide, this reduces the cost of entering the spread to $655. Here's a note regarding earnings reports. The next DDS earnings report is scheduled for November 11. Let's review the trades one more time. First trade was a call purchase. Said to buy to open the DDS September 17 expiration 150 strike call for $47.25. We also reviewed a spread. The spread said to buy to open the DDS September 17 expiration 175 strike call and sell to open the DDS September 17 expiration 185 strike call at a debit of $6.55. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.